And I think we have to keep on reminding everyone that policymakers are going to be data dependent and not move on forecasts or fears. And we have to tell our clients, don't hold your breath for a policy rescue until the underlying environment really deteriorates. That's a tough message to deliver sometimes because people are used to a rescue.
Hi, everyone. I'm Rob Rowe, Regional Director of Research here at Citi. Welcome to the Research at Citi podcast. And we're delighted to have with us on the podcast today, Kate Moore, who's our brand new, spanking new CIO for the Wealth Organization. Kate, thanks for being with us today.
Yeah, thanks, Rob. It's great to be part of Citi now instead of just being a client.
Yeah, and I'm really curious to hear all of your opinions on everything. We're going to start off, though, with markets, because I think, look, we've got tariff uncertainty. We've got capital flows leaving the U.S. We have perceived liquidity risk in treasuries. We've got correlations that seem to be breaking down a bit. We've got dollar devaluation. And I don't know that I can remember a period in time where we've had so many things going on. A lot of people compare this to COVID. We've got a slowing economy potentially. Some people think stagflationary. We got fiscal deficits to deal with, trade war with China now. Boy, it's just a lot of stuff. And I don't know how a chief investment officer looks at investment here and makes advice under these circumstances. Is it fair enough to just say run for the hills and be risk averse, or are there opportunities here?
Well, Rob, I'm glad you listed in exquisite detail all of the things that have been keeping me up at night. In addition to, starting this new job and getting to know the Wealth Organization and getting to know Citi, there have been so many pressing issues when it comes to markets that updating in real time our investment frameworks and our communication to clients has been a significant challenge. So, I'm looking forward to what will hopefully be at some point some calm so I can try and catch up with the sleep I've lost over the last 2 months. But I'll tell you this, especially individual investors, even relatively sophisticated individual investors, have had a bias to action. I mean, we've seen this, of course, on the institutional side as well, which is everyone has always wanted to buy the dip over the last 5-10 years. We've been conditioned to do that. That makes a ton of sense. There are momentary shocks in the market, and particularly in risk assets. And that's generally been a good time to kind of add to risk. But the message that I've been sharing with the Wealth Organization and all of our clients is that the signs of stress have been broadening. And even as some measures of volatility, and I'm thinking about the VIX in particular, are down from their peak, cross-asset volatility has continued to rise throughout the course of 2025, especially relative to the last 2 years. And in this environment where stocks are down and bond prices are down, yields are up, and the dollar has been weakening, it's not a good recipe for, think about risk parity portfolios or for people who were hoping to have a lot of ballast from a diversified portfolio. So it's been an uncomfortable situation, I think, for both institutional and individual investors. I would also say, I've been cautioning a couple things to our clients. First and foremost is I don't expect policy to come to the rescue in the very near term. We have also been accustomed to over the last, I'd say, 10 or 15 years, or maybe even since the financial crisis, this idea that markets will stop panicking when policymakers start panicking. And so people are talking about what could the put be from the policy side? Will we get the Fed stepping in to the rescue? Will we get large-scale fiscal packages outside of the U.S.? What could happen to kind of increase confidence and stem the bleeding? And for a huge number of reasons that we could probably spend an hour talking about, that's incredibly unlikely in the near term. And I think we have to keep on reminding everyone that policymakers are going to be data dependent and not move on forecasts or fears. And we have to tell our clients, don't hold your breath for a policy rescue until the underlying environment really deteriorates. That's a tough message to deliver sometimes because people are used to a rescue. Second point I'd just say, Rob, is that we're also making sure people understand that while perhaps peak tariff panic is over, the likelihood that we're going to have a rapid de-escalation in terms of tariffs is quite low.
So you think that, we will see deployment of tariffs. It will have some effect. I mean, some of them are already deployed. Others are being thought about, and we just don't know what the severity of those are. Are you all looking, cross sectors at different sectors in terms of assessing right now? And I imagine that that's the hardest thing to do, is to assess when there's this level of uncertainty. But are you looking across sectors and saying, where could the benefit be? Where could the disadvantage be?
Yeah, and I will say, just as everyone was looking for moments to enter into the market because there were some softness and risk asset prices, similarly, everyone was looking for kind of good news last week when it came to tariff negotiations. Like, oh, Japan is sitting down at the table. This is going to be progress between, a major trade partner. But I think one of the things we've been really focused on is that, even if like a country like Japan is able to offer concessions to the US, they are in a privileged position to say, will offer to buy more liquefied natural gas or to offer up more direct investment into the US. Most of the countries that are going to sit on the other side of the table don't have anything to really offer. And it's going to be challenging in terms of negotiations. But Rob, you asked this question around, what sectors and stuff we're paying attention to. And I have to tell you, the non-country or regional specific tariffs, specifically around pharma and semis, are very, very top of mind because they have huge implications, frankly, for the consumer.
Mm-hmm. My understanding too is just with pharma alone is that the US really doesn't produce any of its prescription drugs. So,
No.
yeah,
Or generic drugs too, which is important.
yeah.
People just only think about the brand names, but it's all the generics as well, that
Mhm.
we all consume all of the time that will be challenged.
And do you have a view on the auto industry right now in terms of the way you think that'll play out? And my understanding is some of these tariffs, associated with Canada could actually be detrimental to the auto industry. At the same time, the idea that you're being protectionist with some of this in order to allow the US auto industry to be more successful. I mean, how do you view that?
Yeah, this is going to be a really complicated one because we
Mhm.
know that all of these tariffs will be significantly challenging to the auto industry and yet will also likely have an impact on demand. So how much that ends up, sort of filtering through to price and activity in the near term is left to be seen. But whether we're talking about autos or pharma or whatever, we have all these companies announcing either build out or expansion of US production facilities with this idea of like, let's bring production closer to the end consumer. And we'll promise to do that, and lots of headlines to that effect throughout the course of 2025. It's a good time to remind everyone it takes years, not quarters, and many years in some cases to build new manufacturing facilities in the US. Even if you find a production facility for auto parts, for example, or for pharma that you can kind of repurpose. And so it's more of a brown field as opposed to kind of a green field. We're talking 1 to 2 years at best and hundreds of millions of dollars. So I expect we're going to see significant dislocations in some of these sectors that are facing very specific tariffs. And that's
Mhm.
going to have a really big impact on both demand and on pricing.
And I want to switch over globally for a sec because a popular trade idea has essentially been to buy Europe, to look at European equity markets versus the US because of the perception that while the US is tariffing all goods coming into the US, each individual country only has to deal with the tariffs associated with those going into the US. And so that odds are that it'll be more beneficial. And there's also been a lot of talk in terms of Europe in terms of fiscal stimulus, which I don't know if that's arrived yet or what level of fiscal stimulus will arrive, but there's been talk of that too. And that would be also supportive of European equity markets. At the same time, there's been this kind of argument in China about technology and how that may boost their equity markets. But if you're having a trade war, if the two largest economies in the world are having a trade war, I can't imagine that that's beneficial to anybody. But anyway, how do you look at these other regions right now versus the US?
Yeah, maybe I'll address Europe here first, Rob,
Mhm.
because I will say the rotate out of the US into Europe preceded the announcement of some of these new
Mhm.
policies. And a lot of that was just regular repositioning. After a couple years, I'll just say a couple, but really it's been quite a long time of US significant outperformance. People came into 2025 saying it can't last forever. And this is a time to kind of take a couple of my US chips off the table and sort of rebalance, maybe not in wholesale well, but close some of the underweights to Europe and to emerging Asia and even into to developed Asia and Japan. So there was just a regular technical tailwind to some of that trade at the beginning of the year after US outperformance. And then, the story and the narrative really changed to your point, Rob, about, perhaps Europe is going to be in a different position. Perhaps there will be less direct impact. Perhaps European governments will be able to step in with stimulative fiscal. And I have to say, there I remain quite skeptical. If you look at the composition of the European equity market, the highest quality companies have like more of the kind of the free cash balance, more of the sort of growth mindset, are more agile, like their US counterparts are already trading at valuations that look like US companies. Then there's the rest of the market that have high fixed cost base, that are limited perhaps in terms of the labor flexibility, that don't have dynamic products, and those were trading at a relative discount. And so, that in general makes European equities look quote unquote cheaper relative to the US. But when you quality adjust it, that is just not the case. So I just want to highlight that because that's super, super important. And so the kind of fundamental reasons for rebalancing into Europe don't look to be intact. It doesn't mean that there aren't great companies in Europe. I'm just saying that they are already priced relative to their US great company counterparts. And I'm just kind of not holding my breath on the fiscal side. You heard me say this before. I just don't think that we're going to get the governments riding to the rescue. Even the German spending, best estimates, this as well as I do, look like they're going to hit in the second half of 2026. And even there are some like creative accounting, right?
So there might be some ESB monetary easing, though, that's still going to be there. But what you're telling me is that valuation story is a little bit over on the European markets, where it used to be cheap as well. What about China?
Well, China's going to be an interesting case, and this rapid escalation in terms of the trade conflict between the U.S. and China, bears a lot of watching. In the background, while especially U.S. and global investors had been steering clear of Chinese assets for the last couple of years, policy and government spending was really supporting key industries. And we started to see a few of these highlight their strengths in the beginning part of 2025. And I expect that we'll start to see more fruits kind of born from that investment and policy in China over the course of the next 2 years. And the government is going to be really keen on highlighting these things, like around the semis, around AI, around specific advancements. And so, even as this trade war heats up, I think China has the ability to offer stimulus and has had policies in place to support key industries. So I think it's an interesting place from an investment perspective for us to watch over the course of this year, and potentially kind of take some less correlated investment risk.
Fantastic, Kate. And maybe we can switch on that note, switch gear a little bit and just talk about, in terms of the wealth industry, there's a lot of new products out there. There's crypto now, cryptocurrencies. Love to hear your view on that. There's private markets and some of the challenges there as well. And there's also the changing face of ETFs. There's more actively managed ETFs, or at least that seems to be a trend, as well as ETFs that are, addressing private markets and crypto. How are you thinking about those? I guess we could call them all of these newer alternative assets in terms of asset allocation. And I know that we had previously had discussions about 60-40. I don't know how it changes the 60-40 dynamic as well. Is 60-40 still, from a product perspective, it's still viable?
Yeah. So great point here. And
that's a lot. That's a lot to unpack.
Yeah. But maybe I'll start with the 60-40, which is to say, the kind of regular 60-40 portfolio, the set it and forget it, has been challenged for some time. But as I mentioned kind of at the top of our chat, this underperformance of all assets at the same time has really called into question, exactly how we think about constructing portfolios. What can we do to provide real diversification? How can we be tactical? And, what are the instruments and implementation vehicles we can use in order to limit downside, have that ideal low downside capture and most of the upside capture. That's what we always aiming for. I don't know if 60-40 is dead, but the number of headlines around 60-40 being dead has certainly increased in recent times. And I will tell you, we're continually looking at, where we can use alternative implementation vehicles. I sometimes say that alternatives in itself is not an asset class. It's a, implementation to really lower our beta, kind of dampen risk, and to provide, lower correlation stream of returns. What I will tell you, you asked about crypto, and we don't currently have a recommendation for crypto within client portfolios or have it in the portfolios that we actively manage for wealth clients. But what I will tell you is that this is the hottest topic with all of our clients. And we're finding that many of them hold separate crypto accounts. And so as we think about modeling their overall risk, we need to make sure that we're taking that into account. So one of the challenges, though, of course, as you know, is that there has not been consistent historical correlation. We don't have a lot of history on some of this stuff, and people are holding some of these alternative assets for a huge variety of reasons. So I think we are at the very early stages. I'm trying like desperately hard, Rob, not to use a baseball analogy and say early innings, but I think we're at the very early stages of understanding where some of these assets belong in portfolios, what buckets, or if it's its own bucket altogether, and when and where it can provide diversification. I'm saying all of this, but I just want to like underscore something, which is that like being an asset allocator right now is exciting, but also requires, a significantly different type of approach than people have historically, employed. When you can buy, because of your point around ETFs, and super cheap index exposure and super cheap, basically stock bond packages in an active format, there has to be real work done on portfolios and investment advice to justify, higher fees. And that's something that, frankly, fortunately, and one of the reasons why I'm here, we have the opportunity to do in Citi Wealth relative to just like setting a beta exposure. So I would say stay tuned, but asset allocation is evolving. It's evolving at a very rapid pace because of all of these different instruments. And we need to think much more creatively about how to generate the best risk-adjusted returns, because 60-40 is not going to cut it.
I guess you could say that's one of the big challenges for the wealth industry. What are the other challenges? There's asset managers out there, hedge funds, there's everyone competing. How are the capital flows looking as well? And what are investors what are their flows right now? How are those flows going?
Yeah, so it's different across different segment bases. But let me just say this, Rob. One of the reasons why I'm here in this job at Citi Wealth is because we're continuing to see a huge amount of opportunity, in wealth in general. Like this is, true of Citi, but it's really true of the whole industry, to be honest, because there's been a lot of wealth creation over the last number of years. People want to think creatively about how to invest. And here's what I'll say. We have some clients who've been holding large amounts of cash, even as asset price returns were outstanding the last couple of years. And they're kind of itching to put money to work, but have been uncomfortable with it, especially the huge outperformance of U.S. assets. So we're working really closely with them to think about when it would be an appropriate time to add risk. At this point, our advice is, given the uncertainties around tariffs and given the market technicals, now is not the time to add. But we're trying to think about how to do it in the best risk-adjusted way. And I would say clients are also really interested in yielding assets at this point. The expectation that inflation will stay a little stickier and perkier, as it were, is leading to people take greater look at their yielding parts of their book.
And as we come to the close here, Kate, I got one last question, and it's going to be a fun one, which is, what keeps you in this business? You've been in this business now for a while. I guess one would say you got to love it. But what's attracted you to this business all these years, and what keeps you involved?
Well, Rob, I think I'm a little bit of a nerd, and I think that's what keeps me in the business, that and the fact that I love to solve puzzles. I mean, one of the most exciting parts about being a macro investor and kind of marrying the top down and the bottom up is that you're constantly taking in new types of information. There's the policy growth, inflation side of things. There's the insights you're getting from companies, from different industries, and really trying to understand the underlying dynamics of markets and economies is a, incredibly exciting project. I mean, again, I started off with saying I'm a nerd. I'm just going to underscore that, I am a nerd. But what's kept me in the industry, I think, is that I'm constantly intellectually challenged. It's never the same day twice. And there's always an opportunity to learn something new and an opportunity to incorporate new types of data and analysis into the process. So I think that tells us a lot.
Well, you're a nerd and a scratch golfer at the same time, so I think that's
not quite
pretty
scratch,
impressive.
But a girl can have dreams.
There you go. Well, Kate, thanks so much for participating on our podcast, and we're really glad to have you here at Citi. Thanks so much.
Thanks, Rob.
This podcast was recorded on Monday, April 21st, 2025.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyrights 2025 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.